The IRS doesn't wait until April to collect your taxes. If you are self-employed, a freelancer, or running your own business, you are legally required to pay your taxes throughout the year, as you earn money. And if you don't, the IRS charges you a penalty, even if you pay everything in full by April 15th. Today, we are going to show you exactly what quarterly estimated taxes are, who has to pay them, how to calculate the right amount so you are not overpaying or underpaying, and the 2 legal safe harbors the IRS gives you to avoid penalties entirely. Let's get into it. Let's start with the foundation. The U.S. tax system is a pay-as-you-go system. The IRS wants you to pay taxes on your income as you earn it, not all at once at the end of the year. For W-2 employees, this is handled automatically. Every paycheck, your employer withholds federal income tax and sends it to the IRS on your behalf. You don't have to think about it. But when you are self-employed or running your own business, no employer is doing that for you. So the IRS requires you to send in tax payments yourself 4 times a year. Those are your quarterly estimated tax payments. Now the IRS doesn't just ask nicely. This is backed by law. Under Internal Revenue Code, Section 6654, if you expect to owe at least $1,000 in tax after subtracting any withholding and credits, you are required to make estimated tax payments. Let's be specific about who this affects, because we want you to know right now whether this applies to you. You are generally required to pay estimated taxes if both of the following are true. Number 1. You expect to owe at least $1,000 in federal income tax for the year, after subtracting any withholding and refundable credits. Number 2. Your withholding and refundable credits will cover less than 90% of your current year's tax liability, or less than 100% of last year's total tax bill. The people on whom this typically affects include sole proprietors, single-member LLC owners, partners in a partnership, S-corp shareholders who take distributions, freelancers, independent contractors, and anyone with significant side income, whether that's rental income, investment gains, or gig work. One exception worth knowing. If you had 0 tax liability last year, and you were a U.S. citizen or resident for the full year, you are generally not required to pay estimated taxes this year. But if your business is profitable and growing, that exception almost certainly does not apply to you. Alright, now here are the 4 deadlines you need to mark on your calendar for 2026. And I want to point something out before I give you these dates, because it confuses a lot of people. Even though these are called quarterly payments, the periods they cover are not equal. This is directly from the IRS, and it surprises a lot of people every year. Payment 1. Due April 15, 2026. This covers income earned January 1st through March 31st. Payment 2. Due June 15, 2026. This covers income earned April 1st through May 31st. That's only 2 months, not 3. Payment 3. Due September 15, 2026. This covers income earned June 1st through August 31st. Payment 4. Due January 15, 2027. This covers income earned September 1st through December 31st. There is one special exception on that 4th payment. If you file your complete 2026 tax return and pay your full balance due by February 1st, 2027, you can skip the January 15th installment entirely. Add reminders on your calendar, because missing even one of these dates can trigger a penalty for that quarter, even if your other 3 payments were perfect. Now this is the section most people want to avoid, because calculating estimated tax payments sounds complicated. It's not. Let me walk you through it step by step. The IRS has a form specifically for this, Form 1040-ES, Estimated Tax for Individuals. It comes with a worksheet that does the math for you. But I want to explain the logic behind the numbers, so you actually understand what you're paying and why. Step 1. Multiply your total business profit by 0.9235 to find the amount actually subject to self-employment tax. Step 2. Take that adjusted number from Step 1 and multiply it by 15.3%, up to the $184,500 wage base. Save this total. You will add it at the end. Step 3. Start with your total profit and subtract 50% of the self-employment tax you just calculated. Also, subtract any health insurance premiums, SEP IRA, or solo 401k contributions. Step 4. From the result of Step 3, subtract the 2026 standard deduction, which is $16,100 for single or $32,200 for married filing jointly. Then subtract the qualified business income deduction, which is generally 20% of your business profit. Step 5. Use the 2026 tax brackets on the taxable income left over from Step 4 to find out your federal income tax. Step 6. Add the full self-employment tax from Step 2 to your income tax from Step 5. Then subtract any tax credits, such as the child tax credit. The result is your estimated total tax for the year. Divide that by 4 for your quarterly payment. Let me run through a real example so this clicks. Say your business generates $120,000 in net profit for 2026. You take the standard deduction, which is $16,100 for a single filer in 2026. You also subtract $8,478, which is the deductible half of your self-employment tax, to find your adjusted income. You also qualify for the QBI deduction, which is 20% of your qualified income, roughly $19,084 on this adjusted amount. That brings your taxable income down to about $76,338. Your federal income tax on $76,338 of taxable income, using 2026 brackets, is approximately $12,506. Add self-employment tax on $120,000 of profit, calculated on 92.35% of total profit, which is exactly $16,955. Subtract any credits. Let's say 0, for simplicity. Your total estimated tax is approximately $29,461. Divide it by 4, and your quarterly payment is roughly $7,365. Please note that Step 1, where we calculated self-employment tax, does not apply to S Corporation shareholders, C Corporation shareholders, and limited liability partners. Now here's something the IRS actually gives you that a lot of business owners don't know about. 2 legal safe harbors, if you meet either one of them, guarantee you will not owe an underpayment penalty, regardless of what your final tax bill turns out to be. Safe harbor number 1. Pay 90% of your current year's actual tax liability. If your total tax payments, withholding plus estimated payments, equal at least 90% of what you actually owe for 2026, no penalty. The challenge here is that you have to estimate the year's income accurately enough to hit 90%. If your income is unpredictable, it is harder to rely on. Safe harbor number 2. Pay 100% of last year's total tax liability. This is the one I want you to really pay attention to, because it removes all the guesswork. Pull out your 2025 tax return. Find the line labeled Total Tax. Divide that number by 4. Pay that amount each quarter in 2026. No matter what happens to your income this year, even if you make significantly more, you are fully protected from the underpayment penalty. There is one important adjustment. If your adjusted gross income in 2025 was more than $150,000, or $75,000 if married filing separately, you need to pay 110% of last year's tax, not 100%. That's still a simple calculation, and it's still completely predictable. Once you have calculated your quarterly amount, paying it is straightforward. Here are your main options. Option 1, and the IRS's recommended method, is IRS Direct Pay. Go to irs.gov, click on Make a Payment, select Direct Pay, and you can pay directly from your bank account. It's free, it's fast, and you get immediate confirmation. Option 2 is EFTPS, the Electronic Federal Tax Payment System. This is especially useful if you want to schedule payments in advance or pay more frequently than quarterly. Some business owners prefer to pay monthly to keep cash flow smoother. Option 3 is a credit or debit card through an IRS-approved payment processor. Note that fees apply, typically between 1.8% and 1.9% of the payment amount. Not ideal, but it's an option if you are tight on cash in a given quarter. Option 4 is to mail a check. Use the payment voucher, included with Form 1040-ES. Make your check payable to United States Treasury, and write your Social Security number and 2026 Form 1040-ES on the memo line. The IRS uses the postmark date, but try to mail early, because delays happen. Before we close, we want to flag 3 mistakes we see business owners make with estimated taxes every single year. Mistake number 1 is waiting until April to pay anything. Even if you are planning to pay everything by tax day, the IRS calculates underpayment penalties by the quarter. Missing Q1, Q2, and Q3, even if you write one big check in April, means penalties on 3 missed quarters. The penalty is calculated separately for each period. Mistake number 2 is using last year's income to estimate this year's payments, without considering growth. If your business grew significantly, last year's payment amounts may fall short of the 90% safe harbor. Either update your estimate mid-year, or use Safe Harbor 2, which is paying 100% or 110% of last year's total tax, to stay protected regardless. Mistake number 3 is not separating tax money from operating cash. This is a discipline issue, not a tax issue, but it causes real problems. Every time a payment comes in, move a percentage of it into a separate savings account designated only for taxes. That money is already spoken for. Treat it that way. Quarterly estimated taxes are one of those things that feel overwhelming until you understand the system. And once you do, it's actually very manageable. Know your deadlines. Use the safe harbor. Pay electronically. Keep tax money in a separate account. Do those 4 things, and you will never pay an underpayment penalty again. If this video helped you, please do subscribe. because we put out new content every week on tax strategy and bookkeeping for small business owners just like you. I will see you in the next one.